Understanding financial reporting quality. The quality of financial reports refers to the degree to which financial statements faithfully represent a company's economic performance and financial position. High-quality reporting provides relevant, reliable, complete, neutral, and transparent information that supports sound investment decisions. Conversely, low-quality reporting may obscure economic reality through aggressive accounting choices, earnings management, biased assumptions, or incomplete disclosures. Analysts evaluate reporting quality by considering both the quality of the underlying business performance and the quality of management's accounting decisions. A structured framework begins with understanding the company's business model, incentives facing management, accounting policies, and the extent to which reported results reflect sustainable economic activities rather than accounting distortions. Framework for assessing reporting quality. A comprehensive assessment of financial reporting quality involves identifying potential sources of bias and evaluating whether management's accounting choices improve or reduce transparency. Analysts examine accounting standards, estimates, assumptions, and judgments used in preparing financial statements. Common warning signs include unusually aggressive revenue recognition, delayed expense recognition, excessive capitalization of costs, frequent changes in accounting policies, and significant use of non-recurring items. The goal is to determine whether reported earnings, assets, liabilities, and cash flows accurately represent underlying economic reality. High-quality reporting enhances comparability across firms and periods, while poor-quality reporting increases uncertainty and reduces the reliability of valuation and forecasting analyses. Introduction to earnings quality. Earnings quality refers to the extent to which reported earnings are sustainable, repeatable, and reflective of genuine operating performance. High-quality earnings are generated primarily through core business operations and are likely to persist in future periods. Low-quality earnings often rely on one-time gains, aggressive accounting estimates, accounting choices that accelerate revenue recognition, or temporary factors that are unlikely to recur. Analysts distinguish between reported earnings and economic earnings by evaluating the sources of profitability. The objective is to determine whether current earnings provide a reliable basis for forecasting future cash flows, profitability, and firm value. Sustainable earnings are generally more valuable than temporary or manipulated earnings. Evaluating earnings quality through revenue and expense analysis. Revenue recognition is one of the most important areas in earnings quality analysis because management often has discretion regarding timing and measurement. Analysts should examine unusual revenue growth, large increases in receivables, declining cash collections, or changes in revenue recognition policies. Expense recognition should also be evaluated carefully. Delaying expense recognition through excessive capitalization, extending depreciation periods, reducing impairment charges, or underestimating provisions can artificially inflate earnings. Comparing earnings growth with cash flow growth often helps identify potential concerns. When reported earnings rise substantially while operating cash flow remains weak, the quality and sustainability of earnings may warrant closer examination and adjustment. Sustainable earnings and mean reversion. A key concept in earnings quality analysis is sustainability, often referred to as earnings persistence. Persistent earnings are more likely to continue in future periods and therefore have greater value for forecasting and valuation purposes. Analysts must separate recurring operating earnings from transitory components such as restructuring gains, asset sales, litigation settlements, or other unusual items. Financial theory suggests that abnormal earnings tend to exhibit mean reversion, meaning unusually high or low earnings gradually move toward a long-term sustainable level. Understanding the persistence of earnings components enables analysts to develop more accurate forecasts and avoid overestimating the long-term impact of temporary performance improvements. Accruals and earnings quality. Accrual accounting improves the matching of revenues and expenses but introduces estimation uncertainty that can affect earnings quality. Research has shown that the accrual component of earnings generally exhibits lower persistence than the cash flow component. Large accruals may indicate aggressive accounting assumptions regarding receivables, inventory, depreciation, reserves, or other estimates. Analysts often compare accrual-based earnings with operating cash flows to assess quality. When earnings significantly exceed cash flow over extended periods, concerns may arise regarding the sustainability of reported profitability. Companies with earnings supported by strong operating cash flows are generally viewed as having higher quality earnings than companies relying heavily on accounting accruals. Indicators of high and low quality earnings. Several indicators help analysts identify earnings quality concerns. High-quality earnings are typically characterized by strong cash flow support, consistent accounting policies, transparent disclosures, conservative estimates, and stable relationships among revenues, expenses, and balance sheet accounts. Warning signs include rapid revenue growth without corresponding cash flow growth, repeated restructuring charges labeled as non-recurring, significant related party transactions, large changes in reserves, and frequent adjustments to reported results. Analysts should also review management discussion and analysis, footnotes, auditor reports, and industry conditions to identify factors that may influence earnings quality. Multiple indicators often provide stronger evidence than any single accounting metric alone. Analytical implications for valuation and decision-making. Evaluating financial reporting quality and earnings quality is essential because valuation models, credit analysis, and investment decisions depend heavily on the reliability of reported financial information. Poor quality earnings may lead to overly optimistic forecasts, inaccurate valuations, and misallocation of capital. Analysts frequently adjust reported financial statements to remove non-recurring items, normalize earnings, and improve comparability across firms. A rigorous assessment of reporting quality helps identify potential biases, understand management incentives, and estimate sustainable future performance. For CFA candidates, mastering earnings quality analysis provides a foundation for developing more accurate forecasts, assessing risk, and making informed investment recommendations based on economic reality rather than accounting presentation.